Hi, friends. Welcome to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And today we have a bunch of stuff that we want to get into. And so, first of all, we have to talk a little bit about just what's been going on amidst the backdrop of the stock market. So it's officially earnings season. Stock market performance has finally taken a turn. And so I want to talk a little bit about what's been happening. There was also yesterday this really great article in the Financial Times that was titled "How Private Equity Tangled Banks in a Web of Debt." And it had some awesome graphics. It was very educational. Again, I thought it was great, but it was still, in my opinion, it was a little jargony. So we want to break down some of the weird, crazy shit that private equity firms are doing. And some of which that Jen and you messaged me because I sent you this article and you were like, have you heard of this thing before? And I was like, no. So we want to talk about some of the different ways that private equity firms are adding a ton of leverage into the system. And then there was also this other article that we won't really get into it too much. It's just obviously Jen and I are obsessed with Succession. And so there's, I guess, like some secret battle for the Murdoch empire that's going on behind the scenes. So we want to get into that. And then finally, this is going to be a stacked episode. Normally we try to keep these 20 minutes. And then Jen wanted to touch on some feedback we got from our Instagram community last week that basically, I think you had asked people, what do you wish you had known before starting to work on Wall Street? And we got some just really incredible responses. And so we'll wrap the skinny on up with Jen taking us through some of the top tips. And so with that, what should we start with?
Let's start with the stock market. Let's start with the stock market.
Let's start with the stock market. All right. So for anyone who's been paying attention, the stock market has just been on a tear. Since what, 2022 has it been? I don't even know anymore. But it's been going up, mostly driven on the heels of the quote unquote Magnificent Seven. And so for those of you guys not familiar with them, the tech stocks, yeah, but it's like the big names, right? Alphabet, Amazon, Meta, Microsoft, Tesla. Oh gosh, who am I forgetting? Did I say Microsoft? NVIDIA. Oh yeah, and NVIDIA. NVIDIA has basically been like the massive driver because there's this whole conversation about AI and how it's going to just transform everything. And it's basically these big players are leading the charge. And so over the last couple of years, the S&P has been on fire, driven mostly on the heels of these 7 tech stocks. Now, about a week ago, so last week, we started to see that there was a little bit of a shift. Oh, and by the way, I should note that the S&P has, like I said, been on this tear. I think last year it was up something like 24%. The NASDAQ was up almost 50%. But again, it was mostly driven by these tech stocks. And the rest of the S&P of its 500 companies, the remaining 493 had basically been doing nothing. And then there's the smaller cap stocks, so smaller companies, their equity had basically been just like not really doing much of anything. And so over the last week, there has been a shift that has happened. The Magnificent Seven has started to stumble a little bit, and the smaller cap stocks have started to do well. People call it this factor rotation. So I should actually note what that is. Basically, it just means that people are moving from kind of one class of type of stock to another. So it could be size, market cap. It could be they're going more for value growth. It could be momentum. But ultimately, it does seem that there is this shift that has started to happen. Whether it continues, who knows? And some of the theory, number one, inflation cooled. We had like a lower than expected inflation print. And so it's fueling the confidence that the Fed is going to cut rates.
The consumer data is just worse, right? We've got a much weaker consumer than we had. So we've got weakened consumer data. We've got lower inflation prints. And even though we had a nice GDP number this morning, I think that there is a lot more speculation that the Fed is going to cut. They are going to cut sooner, and they may cut more than the market had been pricing in. So if you look at the differential between the 2-year point on the Treasury curve and the 10-year point on the Treasury curve, that has been inverted, meaning 10-year rates have been lower than 2-year rates, which is not normal, all else being equal, since June of 2022. That is very close to disinverting for the first time in 2 years, meaning that the market is now pricing in a much more normal yield curve led by the Fed easing. So I'll let you continue. Sorry, I just wanted to.
Yeah. No, I think that was really helpful. But the main point is that who benefits if rates come down? It does tend to be some of these smaller players for whom going out and borrowing, if it's very expensive, it means that there's less ability to fuel growth. So that's one theory.
The tech companies all have cash. They don't need to borrow.
Right. Exactly. And they also had locked in lower rates pre the Fed hiking. So between their cash and the fact that they had borrowed money and they had locked in lower rates, like they're sitting pretty. Smaller companies, less so. Another theory is just people are seeing the chance, I think, following what happened with the sort of assassination attempt of Donald Trump. And then we obviously now, as of this past Sunday, we have now Kamala coming in. But for a while, there was just this feeling, I think, amongst everyone that it is a done deal that Trump's getting back in office. And with that, there is then less regulation, there is lower taxes, which again, in theory, would benefit some of the smaller players. There has also been this last week, we started earnings season again. And so you saw Tesla actually, they did not meet expectations. Like they were below expectations for their Q2. Their profitability was down to a 5-year low. So Tesla did not come in with good earnings. Yesterday, Alphabet did. But the other thing that happened with Alphabet is they had put a bid in to try to buy this company called Wiz, which was a cybersecurity company for, I think it was something like $23 billion. And they ultimately said no. Now, I have no idea if that affected the stock price, but it was obviously a story that they were looking to buy this company and then they ultimately said no. But Alphabet came in and their earnings were great. I mean, they said that they expected maybe some slower advertising revenue going forward. But I mean, it just kind of speaks to the fact that there is a very, very high bar. It's like, it's not enough to just meet or exceed expectations for the Magnificent Seven. It's like they have to blow them out of the water. And so yesterday, Alphabet's share price was down. And by the way, yesterday was like one of the worst performing days in the market for over a year. I mean, it was just under a year. It does seem that the market's back up today, but that goes back to what we said before, which is that there is still this divergence now between the S&P and the Russell 2000. So the Russell 2000 is these smaller stocks, right? It's a mix of 2,000 of the smaller names. And I think today, I mean, right now it's 1242 and the Russell 2000 is up 2% and the S&P was up what, like 1/3%? So the S&P is continuing to underperform the Russell, which has been, again, the absolute opposite of what's been happening over the last, call it 2+ years. So just kind of interesting in terms of what's going on there. Anything else that I am missing, Jen? Those I think were the main things I had wanted to talk about. But
no, I mean, I read a Bloomberg article yesterday that said, or was it today? I'm jet lagged to just get back to America. I'm completely confused
Jen
about
was
what day, week, year it was. Yeah.
Switzerland for
I was in Switzerland for a month. Yeah. And I read an article on Bloomberg and it was basically like everyone seems to have collectively woken up simultaneously from, the dream of AI being the future and all these things. I don't know that is the case. It's how the market is behaving, though, with respect to these stocks. But all of the true believers that have been around for the past 2 years who were like, every dip is a buying opportunity. Every dip is a buying opportunity. We have to see how that plays out. And what cash on the sidelines is really thinking, is this just an opportunity to add? Or is this a total change in sentiment? I'm inclined to think it's the former, just because I don't know what has fundamentally changed. We've been getting this data for months, and S&Ps have been super resilient in the face of slowing consumer data and slowing inflation data. I don't know why all of a sudden, unless it's that slowing consumer data combined with shifting political winds that might be harboring a sea change here. I'm just not sure. And again, I've frankly been totally out of it for a month, so I have no idea.
Yeah. You're like, Well, it is, I mean, I have heard more and more people who are starting to say, and again, I don't think it's that people are bearish on AI. I think it's just that like, it's been so invested, like so much money is poured in. And I think a lot of people feel like right now, we don't necessarily know who the winners and losers are going to be. Obviously, it looks like OpenAI is the winner, but also at the same time, we don't exactly know where this whole thing is going. And that's what happened in the dot-com burst. What was it called in the 2000s?
The dot-com bubble bursting.
The dot-com bubble bursting, which was, there was a ton of money that had piled in. Like, ultimately, people got the, the internet became this massive thing. It's just that at the time, all this money came in because they saw the potential, but like, it wasn't necessarily into the right places. Yes,
right. We couldn't just say the Wall Street Skinny is an AI company because maybe one day we will use AI and suddenly have millions of people lining up out the door to invest. Yes, which is how it has felt for the past 24 months. 100%. All of a sudden, and like you said, the bar has become so high. So every day for the past 6 months, it feels like it's like now ChatGPT can fold your laundry. Like now, blah, 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 right? It's like, okay, absent you saying that ChatGPT like has, whatever.
Well, no. Sorry, what you were just saying for a second, I actually want to like expand on that, which is, again, everyone sees the potential with these technologies. At the same time, we did an Instagram poll this last weekend, which said, like, how are you guys using AI right now in the finance world?
Yeah.
And it was basically like, people are like, we're not. I sometimes use ChatGPT to do some stuff. Like, but for the most part, it's like, my bank doesn't let me use ChatGPT, or I'm using Copilot, or my bank doesn't let me use Copilot, which again is a Microsoft.
Right.
So it's been an interest. And so I think at the end of the day, it's like, yes, what I think people expect to happen with AI is going to happen. I just think that it's going to take time to see who the winners and losers are.
Yes.
What the actual, like, what it's ultimately going to look like. Right now, it's just a lot of enthusiasm about it, and people that want to put money in because they want to be part of it. But it's still like, you don't really know where it's going. And so I do think at the end of the day, too, it's like you have all these the Mag 7 spending a lot of money on AI. And it's like, cool, but like, what is the actual business model? How are you going to really make money from this? And so I think people are still kind of waiting to see what that is, because right now it's still kind of up in the air.
Yeah.
So that is what's going on in the stock market. So next up, we want to get into what's going on with this Financial Times article. It was actually, again, I thought it was very interesting, and it summarized a lot of the stuff that, Jen, you and I have talked about over the course of this last year. I'm going to basically go through a little bit of a deep dive into the different areas where you are seeing a lot of leverage in ways that we have not necessarily thought of in the past. So, all right. So
before you walk through the article, I think one thing that I experienced over the past 18 to 24 months in my conversations with you is, again, private equity was something I didn't care about, wasn't on my radar, didn't know how it worked, thought it sounded dumb. And we would have these conversations and I'd be like, but what about interest rates? But what about this? And I'd be like, no, this is just how it's done. Like, whatever, it doesn't really matter. Like, people just do these. And I felt like a crazy person being like, I don't understand how you can just do this all day long. And you're like, yeah, and then they just make 20, 25% IRR and it's fine and everything's fine. And like, they just sell the company and whoever buys it, right? And this article felt like it was written by a much more educated version of that outsider that I was, who was like, hang on, you're telling me you're doing what? On top of what?
Yeah.
On top of what?
On top of what?
And there are no consequences and there's no danger to the system from doing all of this? Hang on a second.
Yeah.
That had been my gut reaction, but I didn't have the tools to think about it critically because I was still such a newbie and such a learner. And now that I know enough to be dangerous, dare I say, like burgeoning on some form of expertise on how this system works, reading this article was such like validation that like, yes, these things, there are no free lunches. Like this is potentially problematic. And so for anyone
100%.
who is either a senior practitioner or a burgeoning hopeful trying to start their career in private equity, I highly recommend that you look at the link for this article.
Yes, we'll put it in
our podcast description.
Yeah.
Because it explains so much about how things work, about how the industry is changing, and about what is potentially problematic with it that you need to understand going into it. It will make you think so much better than your peers who are just like 25% IRR, let's go.
Yeah. Well, I mean, this literally is the conclusion of the article. Again, in my opinion, like I like understanding all the nuances. So we are going to dive into how it all works. But they said different types of lending are led by different teams within the bank and often different banks altogether. The lack of oversight has regulators worried about whether lenders can really know just how exposed they are. The debt that ties private equity with banks, insurance companies, and other groups of non-bank financial institutions means that any stress to the industry could ripple across the wider financial system. So it does, again, to your point, feel like there is like the left hand doesn't know what the right hand's doing. There's like someone's like getting leverage and it's like, oh, cool. I've already levered up my company. Now let me go lever up a state, sell out. It's leverage upon leverage. And so anyway, let's get into some of this stuff. And like I said, I think this is really cool. Okay. So we all know the sort of main way that private equity firms use leverage when they are buying companies, right? We've used this example a million times. You buy a company and it's primarily funded with debt. This is just like if you buy a house. In the classic example, you buy a $1 million house, you go to the bank, you get an $800,000 mortgage. You're only putting up $200,000 of cash. This is what private equity firms do. Okay, cool. The next part, which is interesting though, is that historically you would be like, cool, I'm putting in $200,000 of cash. The rest is coming from a bank. Except in the private equity world, it used to be that banks would lend. Now, all of a sudden, a lot of the lenders are private credit firms. And guess what? Those private credit firms are oftentimes those same private equity institutions. Like they have a fund that's dedicated to private equity. They have a fund where they're raising money from institutional investors where it is specifically earmarked for private credit. Excuse me. And so I didn't realize this, but you can actually, so the private credit firm can basically, when they're lending money, like the $800,000 in the example of our house, they could actually borrow from the bank too. So it's like, cool. Not only are they leveraging this significantly, but then they're also leveraging it in the context of the private credit, where, by the way, they're also collecting fees. That's a whole nother thing. Okay, cool. And just to kind of give you a sense of scale, there was actually a really interesting data point, which is that the amount of assets that are managed by these private equity firms, again, managing, again, quote unquote, private equity, is in the order of like $8 trillion, which means it's gone up significantly in the last 10 years. Private credit, just to give you a sense of scale of that market, is in the order of like 17 trillion. So just, there's a lot of money that is, anyway.
Well, I think that's really important to note, right? And again, it's a theme throughout the markets, but a lot of people fail to understand this. Debt markets are bigger than equity markets.
Oh, yeah. I mean, look at the example of buying a house. It's like you're putting in a fraction in the equity, and then the remainder is.
They don't understand the orders of magnitude. And so, if anything, the private credit market relative to the private equity market is undersized relative to the public debt market in its relationship to the public equity markets. Yes. Because, right, especially in the public debt markets where you can have all of these derivatives and things like that, securitized products, et cetera, et cetera. So just, if anything, I think the private credit market is potentially set to explode even higher. I think there's more room for growth there.
Yep. All right. So now that we understand you can borrow against your debt, whatever. Now that we understand how private equity firms basically borrow money to buy companies, the next thing I want to talk about is the private equity firm itself. Because a lot of people, like I said, are not as comfortable with how the funds themselves work. They understand how buying the company works, but not the fund themselves. And so what's important to notice that if you work at a private equity firm, a lot of the times you are going to be required to do what's called a co-invest. You are going to be required to put in your own money to go in alongside the other LPs to buy the business. So pretend, for example, that you were trying to buy a company and the equity contribution was $100 million. And so you need to put up, say, like 1%. Okay. So that would mean you have to put up $1 million. And you're like, cool, but that's a lot of money. You are not going to have to put up $1 million. You actually can get financing for that from the bank. So if you needed to put up, say, $1 million, you could borrow again another 800,000, whatever the math is, and then borrow. Sorry, Jen, I can't do math today. But the idea is that there is leverage upon leverage, and that is in that co-invest piece for the general partners, for the GP. You also have the limited partners. So when you think about a private equity firm, the fund is basically made up of all of these limited partners, the investors who are essentially contributing money that the private equity firm goes and puts to work. And we talked with this actually in our Private Equity 101 episode with AJ about how if a private equity firm goes out and they raise called a $10 billion fund, the LPs are not going to be giving them cash the day the fund closes. It's a commitment. It is a commitment that says, hey, when you find the company that you want to buy, I will wire you the money you need. And so what happens though is that if the private equity firm goes out and they find a company that they need to buy, they may not actually have the cash available yet because they still have to get the wiring from their LPs. And so this is where they can yet again borrow money from a bank to basically bridge the gap. It's called a subscription line. So
Which
it's where
was brand new information to me.
Yeah.
I had never heard of this. And I was also trying to think of the scenarios. Like, really, how quick is the turnaround?
I know.
You guys are doing these due diligence bullshit things for years as far as I can tell.
Yeah.
Like, you suddenly can't wait the 48 hours for a wire to clear, and now you need a loan to bridge the gap. This subscription thing made no sense to me.
I agree with that. I was very confused, but there was, and I don't have the exact part. But there was something like $900 billion. This is like the size of the market last year for like stuff like this. So again, to me, I was like, this is how
and isn't it repaid almost instantaneously once the money comes in?
I know. I did not understand why this is. So if we have anybody
subscription loans, I actually think I have a friend who does this as their business, and I need to reach out to them because I feel like
this was the thing where, again, I had messaged Jen this, and Jen's like, have you heard of this before? I was like, no, this is...
Well, because everything I know about private equity, I learned from Kristen and our friends that we've spoken to on this podcast. And so I was like, no, I know what I know and I know what I don't know. And I've never heard this term uttered by a single one of you before. So this is brand new information. And if it's a synonym for something else, please tell me. We've been out jargoned ourselves, and our whole goal is to make this not jargony for you. So when we don't understand something, first to admit it.
Yeah. So there's more leverage there. Now, as we continue to go on, okay, cool. So private equity firm, they've done their deal. They've bought a company. They've now bought multiple companies, right? They have their whole portfolio. At some point, they have to exit, right? They need liquidity. They have to basically take cash out of the business, give it back to their investors, and that's going to help them raise their new fund. Problem is, two classic ways to exit with what I'll call a monetization strategy that's not exactly an exit. And then we have some other kind of new ones that have come into the mix. But the classics were you can sell, right? You can sell your business to another private equity firm or to a strategic buyer. You can do an IPO. And then the little mini, and I don't like calling it an exit. It's really a monetization strategy. It's something called the dividend recap. It's basically where you bought the company, over time it's paid down debt, say over 5 years, and now you don't necessarily want to sell it. So what do? You go back to the bank, they lend you money. And with the cash that you raise from the debt being raised, you pay a dividend to yourself. So that is a dividend recapitalization. Those have been around forever.
So you borrowed more money to pay out money.
Yes, it's kind of like taking out, I think it's what it called, a home equity line of credit or whatever.
Yeah, HELOC.
Where it's you're basically, a HELOC, exactly. You're basically taking money out of your house and then using it to go on vacation. So it's the same idea.
Or to renovate your kitchen.
Or that too, yes. But we mentioned that, okay, in general, the way that you can exit has been down. The M&A markets have been not as open. IPO market, it's not been healthy. Private equity firms have not been able to monetize. They've not been able to cash out. So yes, they've maybe done some dividend recaps, but what they're really doing, and this is what we had Justin on the podcast to talk about secondaries and this whole idea of continuation funds. And so in this case, it's cool, you have a fund and you need to get money out. So what you can do is basically set up another fund, a secondary fund, and then they buy the crown jewel assets. And so that gets cash coming in. The LPs have an option to basically roll into the continuation fund or to take cash out. But again, when the continuation fund is buying the business, they're still levering it up with debt. So it's okay, we got some more debt on here. We're getting a little long here, but I'll talk about the last thing, which it has been a problem that LPs can't get their money out because whether it's a pension fund, an insurance company, whoever, they do have needs for cash. And so if they want to pull money out, it's not that easy. So there have been these other strategies. There's something called net asset value lending, where the private equity firm basically borrows money from banks using their stake in portfolio companies as collateral. The issue here is that private equity firm's stake in the company is already levered. So talk about leverage upon leverage. The size of this kind of lending is $100 billion last year. The point is and by the way, I don't even know if I touched on everything. There is so much leverage in the system. And as the article talked about, these different players all over the bank that are lending. And it's there's so much debt that has been borrowed and so much, it's leverage upon leverage upon leverage. It's leverage cubed. Talk about instability in the financial system. It's just wild.
Right. Well, one other thing, we talked a lot about capital constraints and regulation last week on the podcast, but most of these players, right, the secondary funds, the private equity funds, the private credit funds, right?
Yeah.
No one's regulating them, right?
No.
They are not subject to the same level of scrutiny that the banks are. So the banks are kind of bit players in this by comparison, as far as they are the regulated entities. They are the ones that the governments are watching most closely and monitoring. There is, by comparison, very little scrutiny of these private capital investors, yet they are the ones employing these strategies. And we get comments on our social media all the time. We got a really special comment this week. MBS should be outlawed. Did we learn nothing from the financial crisis? Sir, if you think that mortgage-backed securities are what are going to take down the global economy this time around, you have not been paying attention. So I don't want to sound all doom and gloom. Hopefully everything's going to be fine. And we just talked about how the Fed's going to ease and everything's going to be great and interest rates are going to be down. But you're watching the wrong thing if you're focused on how mortgage-backed securities present a danger to the public.
Yeah. I mean, the thing that, again, like, and we don't need to get into a whole thing on this, but like, they have wildly changed the standards to being able to borrow money. It is so difficult.
Well,
like,
they've wildly changed the standards. Wait, hang on. They've wildly changed the standards for people like you and me, but you're willing to lend to these private equity and private credit institutions. Out the wazoo.
Yes. Sorry. I meant in terms of the housing market. So like, if you want to take out a loan to buy a house, you better have we had trouble borrowing money because we were moving to a different state. My husband was getting a new job and they were like, you have no history with this employer. And it's like, because it's a new job. What do you expect? Whereas anyway, it was like the dumbest thing in the world. But for the conventional conforming loans, the standards are quite high. So I don't know. I'd feel pretty good about investing in MBS if it were me. That's just my 2 cents. Back in 2008, hell to the F no. No, now? Yeah, I mean, anyway, yes, I would feel much better about it. So any other words, gentlemen, private equity doom and gloom?
That article was a vindication of how I have been feeling for 18 months and just being like, I guess I don't really understand this. And it's like, no. Again, this is how I felt at Lehman Brothers in 2006 when everyone was like, what are you talking about? We'll just rate this CDO AAA. We just make a AAA rated CDO and that's how we're going to divest of this tolling obligation. And I was like, but why? And they were like, shut up, little one, you don't know. And here we are again. And I'm like, wait, but how do you get this return every time with this amount of leverage if rates go up? And it's like, hand wavy, blah, 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 blah. Okay. No. So I'm really curious to understand a little bit more about some of these finer points, like the subscription loans, like the NAV loans, things like that, to understand the sizing of that market. Again, like you said, it was what, 900 billion or something in the subscription loans.
Let me look. And by the way, apparently you can do it both in private credit and private equity. Subscription line, 900 billion in 2023. Yep.
Yeah. So again, I want to understand these things better. We're going to do some more research. We're going to find some experts to explain these finer points to us so that we aren't fumbling around in the dark. But if you ever feel like you don't fully understand the mechanics, guess what? Neither do the experts.
Most people don't. Yeah, no, most people don't.
And speaking of things we wish we had learned, that's a really clumsy segue into kind of the final thing we wanted to talk about. So Kristen mentioned every week on our social media, we try to do a fun little Ask Me Anything prompt. And we get thousands of responses every week that are it ranges from some really obscure technical question to what do I wear to my interview next week to I can't tell you guys apart. We know. Okay. So we decided to switch it up last weekend and we turned it around with a super informal poll, super broad, open-ended questions, just hoping we'd get a couple of fun responses to noodle on. And we were overwhelmed. We got thousands of responses to these kind of poll questions and have been trying to condense them down and formulate a thesis or some takeaways on each of the different items. So we asked what was the best place you ever interviewed? What was the worst place you ever interviewed? And spoiler alert, there were a lot of places that people said were the best and also said were the worst that topped both lists. Exactly. But one of the things that we asked that I really enjoyed reading the responses on was, what do you wish you'd known before starting your Wall Street career? And so I tried to condense this down into the top 5, basically. And there was one theme above all the rest. So here are the top 5 categories of responses that we got where I just tried to summarize. One was that the most competitive or well-traveled route is not necessarily the best. We talk about this all the time. The hype right now about the private equity path or whatever relative to other paths that might earn you significantly more money faster or have a better lifestyle or help you achieve objectives that are more in line with your personality. Again, that is such an important takeaway that I think both of us had in our careers and that we are hearing consistent feedback from our community that more people wish that they had known that before they started. Another thing that someone shared with us very succinctly here that summed up another of other responses was, your job today will not be your job in 2 or 3 or 4 years. It changes all the time. And I thought that was really interesting because what you're chasing now might be the cool, sexy thing. It might shift. That's one way to look at that the industry is shifting itself. Another thing is, too, you evolve with the job, right? So your role is going to change. Who you are as a person, what you bring to the table is going to change. So planning for, it's like when you buy your first house, right? Anyone who buys their first house thinking they're going to own it in 30 years, I mean, statistically, you're insane to think that, right? The average first-time home buyer owns their home for fewer than 7 years. So I think it's really important to know that what you're applying for now, even if you think you have this predetermined path laid out before you, it may change a lot.
And sorry, just to echo that, I mean, but that's something that we've talked about a bunch, especially with investment banking, that like at the junior level, you're almost like a Excel monkey, right? You're doing PowerPoints, you're in the weeds, it's very technical. And then as you work your way up and become a VP, now all of a sudden it's much more client relationship management. It's going in front of the client, it's pitching to them. And by the time you're an MD, I mean, it's a full-on sales role. So it does drastically change. And the type of person that is good as a junior banker, I mean, actually might not be a good MD. And especially as you get more senior and then you have to manage people, that's a whole other angle. So it's like the skills that can make you good when you're younger. And this is assuming AI is not doing anything. This is assuming everything stays the same.
Which
the market
it doesn't
stays
seem
the same.
to be, by the way.
Right, so far, seriously. But I did want to just make that point that even like the old school banking, you start in the 1990s, like it's still, the path goes from very technical to sales very fast.
That's a really great point. Okay, so number 3 was that firm culture, growth opportunities, and mentorship matter more than prestige. Could not agree more in terms of the longevity and ultimate success of your career. However, we talk about this time and time again, that sometimes as a short-term play, trading prestige and just sucking it up for a few years may get you where you want to be. It really depends on the opportunity set. It depends on the firm. But I think that for anyone who wants longevity in their career and wants to grow and wants to maximize their chances of happiness, I think that's perfect advice.
Yeah.
I just think actually that prestige does play a role in a much bigger way. And not necessarily a good role, right? But it is part of the gamesmanship of it all and shouldn't be discounted.
Yeah. I mean, it's like you get a stamp of approval on your resume if you go to like a Goldman Sachs. Like now you are, it's like you have that credential and it does potentially open doors that otherwise would not be open. And I also, just to echo kind of something you said, like the things that are going to make you happy when you're younger might not be the same things that are going to make you happy when you're older. And what you look for early on in your career could change. So like you said, the job that you have today, it could be the perfect job for you today. And also like if it stayed exactly the same, it might be the absolute worst job for you in 2 to 3 years. Like you just never know. And so I think at the end of the day, like being flexible and saying, I'm going to optimize for what I think is the best in the next X number of years, 2, 3 years. Like I wouldn't say, oh, don't go for prestige. I think like there is an argument sometimes to go for that. But like, I think ultimately, like when you get to be a little older, it's the last thing. Like you could not pay me. Well, obviously, so you'd have to pay me, but like there's no money in the world that would like get me to take a job at like a Blackstone now. Like, no. But when I was 22, 23, sure, of course.
The next one was that you have to be an interesting person in order to be able to succeed. We say this all the time. Don't want to belabor the point any further, but this is 1,000,000% true. When you have 315,000 applicants for 3,000 summer internship spot, I don't care how great your school is, how great your major is, and how great your grades are. If you are boring in an interview, you are not getting that job, period, full stop. It's just not going to happen. So focus on the things that make you an interesting person. It's going to help you politically. And it's also going to make your life better, by the way. Like we talk about all these intangibles and I know everyone's like, oh, I got to get the job. No, that's not going to be what getting the job is not going to be long-term happiness. It's like winning the gold medal at the Olympics. Okay. what's next, right? What happens 1 week after you win the gold medal at the Olympics, right? Think about that. Another piece of advice that is excellent advice is that everything starts earlier than you think. We've talked about this ad nauseum in the context of the private equity recruiting cycles, but unfortunately, as things become increasingly more competitive, it's no longer sufficient to just be like, oh, it's my senior year in college and I'm waking up in January and thinking about maybe I need to get a job after I graduate. It simply doesn't cut it. And so if this is something that you can identify early on that you might even potentially be interested in, explore it earlier rather than later. Worst case scenario, you find out you don't like it and you're out and you don't have to listen to this podcast anymore and you go on your merry way, right? You can follow us for like watching us make fools out of ourselves. But the earlier you identify that this could be something that you might possibly one day be interested in, you're supposed to explore it right then and there because it will continue to keep doors open for you that might otherwise close in your face without you ever knowing about it.
Yeah. 1,000%.
And then the very last thing, which overwhelmingly, this is what we got as responses for what people wish they had known. I'll sum it up with this one response. It was, good grades in school don't count once you're actually on the job. Spend your time instead on extracurricular activities, which falls under be an interesting person, and networking. I cannot tell you the number of people who were like, networking, just all caps, as their only response to what they wish they had known. Networking, networking, networking. So, I mean, along those lines, if you guys haven't listened to it, way back in ancient history, episode 42, I think, was our Networking 101 episode where we really got into the basics. And we are going to be doing a special follow-up episode with an extremely high-powered woman on Wall Street. I think we're recording that in a week or two. So stay tuned for that. She's so much, I mean, she has made an entire career, an entire business out of networking and being, you know, everyone's like, oh, I got a guy. Okay, well, being the gal, right? And so that's definitely something you're going to want to stay tuned for. And with that, anything else, Kristen?
No, I just wanted to quickly touch on the whole Succession Murdoch thing. Murdoch, who's 93, is in court trying to block his 3 children, or so I should say 3 of his children. He has 6 children, by the way.
Can you explain who Rupert Murdoch is and what his company is?
Sorry. Okay, sorry. Yeah. So let me back. Okay. So there was this article on how there's this secret battle for the Murdoch empire. And so Rupert Murdoch, I'm assuming most people know who he is, but if you don't, he was the founder CEO of Fox Corp. And so the whole storyline of Succession, the HBO TV series, was literally based on this. He has, I think, like 6 kids maybe, but 4 who were sort of the main ones, 2 girls, 2 boys. And one of the sons is much more conservative than the remainder of the 3. And so he put his more conservative son in charge, and he wants to make sure that Fox stays super conservative after he dies. And so his other 3 kids, who are, I don't know their political leanings, but they're much less conservative. I think one of them might even be like liberal. And like, so he wants to quote unquote protect them from moderating and not being as like conservative. And so they're now in this like bitter battle to try to prevent them from having any say over the company, and just has his one son. So it's huge Succession vibes, and
life
obviously
imitates art, imitates life.
True. Yeah. But again, quite literally, the whole plot of Succession was very much outwardly based on this. So art was imitating life. And then, yeah. So that wraps it up. This weekend will be a deep dive into equity long, short hedge funds. We have a really fantastic guest. Well, thank you guys for being here. We love doing this with you, and we will see you on Saturday. So bye.